Now let me talk to you about equity. For this, I will give you a little bit of brief background. From 1760 to 1840, something great took place in our world. Industrial revolution took place. Industrial revolution, things happened very fast in terms of discoveries and inventions. The net result of for our class for 201, the net result for industrial revolution was that three things happened. Earlier, people used to produce things, create things, fabricate things at home. After industrial revolution, virtually all the people started working in the factories. Earlier, things used to happen in smaller scale. After industrial revolution, things started happening in larger scale, big businesses. Now, to undertake all these things, you need money. So we will say, before industrial revolution, you used to require little amount of money to start the business. Now, after industrial revolution, you needed more money. And more money means you need to raise the money from the public. And over here, you will encourage public to invest money in your business, in your company. So how the system came into, in order to encourage the larger number of people to invest money in business, companies develop a system of issuing shares. Shares are units of your capital. If you have capital of $1 million and your units of the capital are $5 each, so you'll be issuing something like 200,000 shares to the public. Public, 10 people, 100 people, 1,000 people can buy this share and give you the money at the rate of $5 per share. So that is the way you raise your share capital. Share capital, or you can call it stock. Why do people give you money? Because when you are doing business, you will make profit, and profit at the end of the period, 1 year or so, you will like to distribute to the people who contributed the capital. So the profit which is distributed to the public, the people who contributed money, is called dividends. Profit distributed is called dividend. You may recall from your chapter 3 or so that every business prepares income statement, every business prepares retained earnings, every business prepares balance sheet, and from retained earning we pay the dividends. Now, a little bit more information about how do we raise the money from the public. Few people, enterprising people, call them promoters, call them entrepreneur. They may decide that let us start the business. They will find out the name of the business, where they will establish the business, what will be the main objectives of the business, how much capital you will need. So you will decide about $50 million you will raise in the lifetime of the thing. This is a target. You don't raise $50 million, but this is, you tell the people that maximum you can raise $50 million, and this is called authorized capital or nominal capital or registered capital. Being a wise or prudent business, you may decide to raise, let us say, only $10 million. So one of these days you will announce in the newspaper that your company is going to issue shares to raise $10 million. People know this is a good idea. They will apply for the shares and send you the money. Once you decide to allot the shares for $10 million, you will receive the money from public, $10 million, and you will issue the shares. From that part onward, in your balance sheet, you will show cash account $10 million. On the liability side, you will show common stock $10 million. Both the sides of balance sheet should be equal, 10 million, 10 million. So typical entry at the time of the issue is cash account debit, whatever cash is coming, and common stock. Shares you can also issue if you feel like when you buy some assets to avoid too much involvement in the cash. Suppose you like a building which is worth $1 million. You can buy the building, so you will say building account debit. It is coming to you, and you will issue share common stock $1 million. In order to reimburse the promoters of the company for whatever money they have spent in formation of the company, in establishing the company, you may also give them shares. So you will make the entry for that. Organizational expense debit, let us say were $50,000, 50,000. Common stock credit, $50,000. This way you do the things. Now, if your company's name is good, later on you may issue shares at a premium. Premium means that whatever is the value of the share, whatever is the value of the share, that is called the par value or the face value. Suppose your share is worth $5 and you have issued 10,000 shares. So how much cash you will get? $50,000. You will make the entry cash account debit, common stock credit, 50,000, 50,000. But if you are issuing shares at a higher value, that means instead of share of $5, you are issuing share is still $5, but you are asking public to pay $6. You will receive how much cash? Cash 60,000, 10,000 shares of $5 each, but you are issuing at $6, so 60,000. Common stock, $5 each for 10,000 shares, 50,000, and 10,000 is the premium. You will put it in paid in capital in excess of par. That is the name of the premium. This is like a gain, but you don't put in the income statement. You show this thing along with the common stock on the liability side. So first you will show common stock, then you will show paid in capital in excess of par. Same way you can use these shares which are issued at the premium when you are acquiring a building. Suppose you bought a building which is of $12 million, you can issue some shares, and whatever premium you are charging, you could show separately in the paid in capital in excess of par. Right? So depending upon how well you are doing the business and you are earning good name, you can issue the shares at premium. Okay? So let me repeat again. The entry for issuing the shares premium is cash account debit, par value plus premium, common stock only par value, paid in capital in excess of par, that is only premium. Read in the chapter, you will find it out. Now, at the end of the year, you will prepare your income statement, how much sales revenue and other revenues you have earned, and how much your cost of goods, how much are your other expenses. So after that, you will find out how much net income you have made. This net income you will transfer in the retained earning. If you don't distribute this money, it is being retained in the business. If you distribute a part of it, the part you are distributing is called dividend. When you declare the dividend in the general body meeting, shareholders will approve it, and then you can pay the dividend. For dividend, two entries are required. First entry is retained earning debit, how much dividend you are going to pay, and dividend common dividend payable. Retained earning debit and common dividend payable credit, because you are going to give it as a liability, because when you pay it, then you will make the entry common dividend payable debit. Now you're paying off liability, and cash is the dividend you are issuing and going to the shareholders. Remember this thing. Now, at times, depending upon your needs and future expansion plans, at times companies may decide not to give cash in dividend. They might issue their own shares to their shareholders. And in that case, whatever amount of shares you are going to distribute, we call it bonus dividend or stock dividend. Entry would be retained earning debit, common stock. And if you are issuing common stock at a premium, the entry would be retained earning debit, common stock, paid in capital in excess of par. Generally, in the British system, companies were not allowed to buy back their own shares. But nowadays, we are in America. In America, companies can and they do buy their own shares. When you buy back your own shares from the public, the entry is treasury stock debit because you're buying this thing. It is like your asset, and cash, whatever cash you have paid to acquire this share. Now, this treasury stock will not appear as investment in asset side. This will be appearing in your liability side as a minus, as a subtraction from common stock section. Common stock, retained earning, paid in capital in excess of par. These are the three items you normally show. If you have purchased treasury stock, you will show it as a minus because you don't pay dividend to the treasury stock, so you minus, so you can work it out from there. Now, initially I thought I will not talk to you about another source of raising money for a long period. And that's another source is the way you issue bonds, the way you issue common stock. You can also issue preferred stock depending upon the mood and the requirement of the market. This is have preferred stock or preferred shares. They have the traits or characteristics of bonds and some characteristics of the common stock. They are more secured than common stock, but less secured than the preferred stock, than the bonds. When you issue preferred stock, there are two peculiarities with this. One is that whenever a company makes profit, preferred stock or preferred shares would be paid dividend first. How much dividend would be paid? It is usually stated when you issue the preferred stock. Okay. For example, if you decide that throughout its life, preferred stock may be getting 8% dividend. So from the income, you will first give dividend to the preferred stock at 8%. And the entry typically would be retained earning debit, preferred stock dividend payable, whatever is the calculation, number of shares times 8%, whatever is the value of the shares. And when you make the payment, you say preferred shares dividend payable, debit, and cash. You always see what is the worth of the shares and calculate 8% of that. That will be the amount of the thing. Number two, if company happens to go in the liquidation, then first you will pay the bonds, then you will make the payment to the preferred stock, and then you will make the payment, if any, to the ordinary stake. Preferred stock can be cumulative, can be participatory, can be convertible, can be redeemable, variety of things are there. I will just say 2 words about cumulative preference share. What are cumulative preference shares? If in 1 year, let us say, you did not make enough profit. If you did not make enough profit, you can't go pay the dividend because dividend is paid only from the profit. If there's no profit, you won't pay the dividend. So if there is not profit, you will not pay. But if your preferred stock is cumulative, that means next year when you made enough profit, you will pay the dividend for this year for which you did not pay and for the next year for which you have the profit. So you will make the payment. So cumulative preferred stock will get accumulated dividend for the years missed out and the year you made the profit. In non-cumulative, you will always get the dividend only for that. I will again request you people to read the chapter, read the PowerPoint slide. Okay? My overall suggestion, at the end of each chapter in your book, you are given some multiple choice question 5. go over those. Then there are some quick study and exercises. I do 5-6 by way of practice. And if there is a problem, God willing, we will meet sometime in April through email. Please ask question. I will, when I get a chance, if I succeed in accessing my thing, I will do my best to reply. Thank you very much.